So we're going to have a quick look at capital gains and why buying more investment properties whenever you can, especially in Auckland, is a really good idea. So we're going to take a look at $1 million Auckland property as an investment. So we're going to take into account that it's 100% financed, it's $1 million property, you're putting $1 million of mortgage on that property using your equity and various different ways. And so we're going to put $1 million down in 2018. And the interest only expense is going to be $45,000. We're going to take into account that it's a 4.5% 2-year interest rate. So what does this look like? Over the course of the first year, the interest, the debt expense, and the expense for owning the property, $45,000. Rental income at $750 a week gets you only just under $38,000 in rental income. So what does that mean? That means that you are going to be negatively geared, and so the cash flow isn't going to cover all of the expenses. So to the tune of $7,250, maybe plus or minus a few other expenses, you're going to have to put more money into that property. Second year, numbers get a bit better. Interest only expense stays the same. Rent goes up. Maybe you do a bit of minor improvements around the property. Rental demand in Auckland very strong, so rent goes up. Year 3, same story again. The debt expense is still the same. Rent's gone up. We've done some renovations, tidied the property up a bit, got some better tenants, put a new kitchen or bathroom in, maybe just minor things. $42,000 comes in for the rental income in year 3, still negatively geared for $3,000 you're going to have to put into that property in year 3. But what the interesting thing is the negative expenses to the tune of, say, 7, 6, and 3, let's call it 20 grand of expenses, even if it's 25, 30 grand. What's happened in the capital gains based on historical data and predicted events that's going to happen in Auckland is capital gains of at least 5% if you buy well. Property was $1 million, you made sure you bought well. In year 2 it's worth $1.50. In year 3 1.1. And based on the data, those numbers do hold true. It should be actually worth more than that. So what does this mean? It's cost you, the net expense is around about 20-30 grand, but your net gain, your gross gain is 100 grand on the capital gain. So that means you've made about 70 grand over the space of 3 years just owning this property. And what you have actually got is tenants that from now on, there's going to be a threshold between now, 2018 and 2028, over a 10-year period, where the rental income is going to balance out with the debt expense, and that anything over and above that is going to be positive cash flow. And what we can see is in 10 years, the property should be worth at least $1.5 million. So what you've effectively got is you're owning a property that is getting capital gains of $50,000 or more every year in Auckland. The rent starts to catch up to cover the debt expense, and then it meets it. The capital gains are much, much bigger than that shortfall. And so what it means is the bank's going to lend you $1 million. You're going to own a property, and you're going to be privy to the benefit of all of the capital gain. And then if we project 20 years out, we go from 2018 to 2038, property's worth $2 million, maybe more. The debt expense is still the same, adjusting for inflation. It is actually a hedge on inflation, getting debt, because the debt amount won't change, but inflation will make the value of the property more, and the dollar value of getting the debt now is much better. But the interesting thing is, with rent going up, maybe getting about $1,500 a week of rent or more from this property, and this property is netting you 30 grand of cash flow a year. So what it means is over the course of 10 years, over the course of 20 years, your property has gone from $1 million to 2 mil using the bank's money, so you made $1 million, and now you own an asset that's bringing you 30 grand a year. And so this is, very primitive model, and this is a capital gains model for Auckland, and you have to have the servicing income to be able to do all this. But as you can see, over the long term, if you can manage to hold the property and keep up with the shortfall and the rent covering the mortgage expense, then as long as you believe that there's going to be capital gains in Auckland, which there has, the last 50 years, you see the numbers. If you believe in the demand in the Auckland market, what you want to do is buy property that you can afford, that has potential value either through land banking or really strategically placed, school zones for example, that you believe that in 20 years time it's going to double in value as a minimum. And as a general rule in the Auckland property market, people are saying, oh, property values double every 10 to 12 years. I'm trying to be conservative here. You guys just need to understand that on property investments, interest-only loans are doable 5 years, 10 years, we've seen it, and you can refinance and extend that out and get another period of interest-only debt. You just need to be prepared to pay that shortfall for as long as it takes for the rent to catch up. And it's just that the double-edged sword of trying to find property that meets your capital gains requirements and cash flow requirements. And usually you get really good capital gains and not good cash flow, or the other way around. So buy well, understand the concepts, and be patient. We work with people in their 80s, 70s, 50s, people that bought property, built up a big portfolio over the last 20, 30 years, sometimes 40 years. And the reason they've done so well is not necessarily because of the cash flow from the rent coming in, but because when they bought this property, say in 1998, it was only, $100,000 or $200,000. And the reason they've made so much money is because of the capital gains. So there's a lot of property investors that say don't buy for capital gains, but they still get capital gains on their properties. So understanding the concept is an important part of being a savvy investor.